G'day Gain Squad, we are back in the hot seat today with an absolute heater of a market update. Let's see where the smart money is flowing today as we navigate this absolute whirlwind of a week. Today we're covering the fallout from Trump's prime-time address and the massive spike in crude oil prices. We will also dive into the tech wreck hitting the Magnificent Seven and record-breaking copper price movements. Plus, a deep dive into gold's technicals to see if this correction is a proper golden entry for us. Quick disclaimer, this content is for entertainment only and isn't financial advice, so keep your wits about you. The big question, do you reckon the Strait of Hormuz situation is going to send gold past 5,000? Tell me your thoughts below, smash that like, and subscribe to join the crew of legendary gold getters. We are zooming in on the 3-day window from March 31st to April 2nd, and it's been a ride. Things kicked off on Tuesday, March 31st, with a cheeky bit of optimism trying to lift the mood. Markets actually rallied because there were whispers that a deal with Iran was finally on the cards. But that vibe didn't last long, as the transition into April 1st brought a massive reality check for everyone. President Trump took to the podium on Wednesday night for a 19-minute primetime address to the nation. He basically told the world that the war is nearing completion, but the threats are still flying thick. He warned that if a deal isn't reached, he's ready to bomb Iran back to the Stone Ages, honestly. We're talking about specific threats against power plants and bridges over the next 2 to 3 weeks. This sent the energy markets into a proper frenzy, because the Strait of Hormuz is still looking chockers. Trump basically told other countries they need to take the lead on securing those vital oil routes. It's a total game of chicken right now, and the market's having a bit of a wobbler over it. Crude oil futures for May 26 absolutely skyrocketed after that speech, gaining nearly 6% in one go. WTI crude is holding firm near $112 a barrel after that massive surge. The OVX, which tracks oil volatility, spiked up to a crazy 93.14 on April 2nd. This isn't just noise, it's a massive supply shock that is pushing every commodity through the roof today. Iran's military command isn't backing down either, vowing more destructive attacks in response to the US threats. It's a total mess in the Gulf, and shipping costs are screaming higher as the blockade continues to bite. For our gold getters, this geopolitical chaos usually means one thing: a massive floor under the gold price. But it's a weird one because even with the war, the US dollar is flexing its muscles lately. The US dollar index, or DXY, rose 0.4% as traders ran back to the safety of cash. This creates a bit of a tug-of-war for gold, as the safe haven demand fights against a stronger greenback. Let's look at the industrial side of things, because Dr. Copper is absolutely having a blinder of a week. Copper futures hit a record high of $5.68 on Thursday, April 2nd, specifically. On March 31st, copper was sitting at $5.61 before the big breakout. This move is huge because copper usually tells us what the real physical economy is actually doing. While everyone is worried about war, the demand for copper for AI data centers is still through the roof. It's a classic case of industrial demand meeting a massive supply crunch from all these global trade frictions. Copper has climbed 41% over the last year, which is a total no-brainer for infrastructure bulls. If you're looking at the copper to gold ratio, it's currently sitting around 0.000075. This ratio is a major macro indicator, and right now it's suggesting the industrial side is still incredibly tight. For an Australian audience, this copper surge is bloody brilliant for our local mining sector and exporters. We are essentially the world's quarry, and when the red metal rips, the ASX usually follows the lead. However, the ASX 200 actually fell 0.7% overall in the month of March recently. It closed the month near 8,501 points, dealing with some serious energy shocks. But don't stress, because historical data shows the ASX often recovers strongly after these geopolitical events. Smart money is watching the Aussie dollar pair very closely as it trends toward 0.69. The Aussie dollar took a 0.6% hit after Trump's speech as the risk-off sentiment took over. If the Aussie dollar breaks below 0.6838, we could see some proper downside for the currency. Our local banks are also feeling the pinch, as the RBA keeps the cash rate at a high 4.1. Westpac fell 4.1% in a single session lately, as rate pressures started to weigh in. But even with the banks struggling, our local energy stocks like Woodside are holding up like total champions. Now, let's pivot to the big tech scene, because the Magnificent Seven are looking a bit dusty lately. The market's been humbled in the first quarter of 26, and the tech giants are leading the slide. The MAG's ETF, which tracks these 7 stocks, is down 11.5% so far this year. We are seeing a proper rotation out of high-flying tech and into more boring, consistent value plays. The sharpest decline so far in 26 belongs to Microsoft, which has absolutely tanked recently. Microsoft is down roughly 17.4% year-to-date as the AI spending worries start to mount. Traders are starting to ask if the billions spent on AI capital expenditure will ever actually pay off. Tesla is also having an absolute shocker, with shares dropping around 18.9% so far. Its margins are starting to look like a legacy car maker, rather than a high-growth tech darling anymore. Amazon hasn't escaped the carnage either, sitting down 13.5% for the year to date. Even the AI king, Nvidia, has slipped 0.6% as the momentum starts to finally cool off. Apple is the only one showing a bit of grit, down just 0.8%, acting like a defensive play. Meta Platforms is also being hit, down 2.7% as investors pull back from the risk. Alphabet is rounding out the group with a 3.3% slide since the start of January. This Mag 7 malaise is dragging the S&P 500 down, which is 0.8% lower. It feels like the air is coming out of the AI bubble, and the smart money is moving elsewhere. We're seeing a massive rotation into materials and energy, which is where the real value is hiding now. Tech bulls are hoping for a seasonal rebound in April, but the charts are looking a bit shaky. If the MAG's ETF breaks its support, we could see a total drubbing of another 10 to 15%. This is why diversification into commodities like gold and copper is a total must-have for your portfolio. Let's look at the broader US market, because the S&P 500 is at a major turning point. The index had a bearish reaction after retesting its 20-day moving average on April 2nd, sadly. It's currently sitting near 6,593, but the momentum is clearly to the downside. Bond yields are also surging, with the 10-year yield returning to 4.39% recently. This is making those high-growth tech valuations look way too expensive for most institutional fund managers. When yields go up, gold usually faces a bit of a headwind because it doesn't pay a dividend. But the war premium from the Iran conflict is keeping gold from falling into a total black hole. Many traders on Reddit are calling this the perfect storm for a massive commodities supercycle in 26. Wall Street Bets is buzzing about the Hormuz squeeze and stacking gold miners as a hedge against the crash. They're moving away from Nvidia calls and into physical metal, which tells you a lot about the vibe. There's also huge hype around the SpaceX IPO, which might fracture some of that Musk brand loyalty. People are worried that the money will flow out of Tesla and into SpaceX, leaving Tesla holders in the lurch. This is all adding to the volatility, which is why your stop losses need to be tighter than a drum. On the Forex side, the dollar bulls are eyeing a break above the 100 level on the DXY. If the dollar keeps ripping, gold will have a hard time smashing through those major resistance levels. But if we see some cool inflation data later this week, we might get that golden bounce we want. Let's talk about the physical oil market versus the paper oil market, because there is a massive gap. The spot price for real physical oil is reportedly around $140 in some places. Meanwhile, the paper futures are only trading around 110 to 112. This basis gap suggests that there is a massive shortage of real oil that hasn't hit the charts yet. If the Strait of Hormuz stays closed, we could see the paper price play catch up very, very quickly. Some analysts reckon oil could hit $150 if the bombing of infrastructure actually happens. That would be a total disaster for inflation and would likely force central banks to keep hiking rates. This is why gold is the ultimate insurance policy for your wealth during these crazy geopolitical transitions. It's the only asset that doesn't have counterparty risk when the world starts falling apart, Gain Squad. Even central banks are hoarding the stuff, with China and Brazil stacking gold like there is no tomorrow. This structural demand provides a massive flaw that the paper traders just can't seem to break through. So, don't let the short-term wobblers scare you out of a solid, long-term position in the yellow metal. Every time gold dips into the $4,600 zone, the buyers seem to step in hard. It's a proper battle between the big macro forces and the daily technical levels on our screens. We need to stay flexible and wait for the high probability setups before we pull the trigger on a trade. The market is giving us plenty of opportunities. We just need to be patient and wait for the signal. Watch the news flow out of the White House tonight, because one tweet can change everything in seconds. If we get a ceasefire, oil will tank, and gold might have a quick correction before the next leg up. But if the deadline passes with no deal, get ready for some serious fireworks across the entire complex. This is where the real money is made, legends, by staying calm when everyone else is panicking. Keep your eyes on the prize and remember that volatility is our friend if we manage our risk properly. Now let's optimize this entry with some gold technicals for the period ending April 2nd. Gold futures are facing a bearish flag pattern on the daily chart after a massive 17% rally. Support is holding steady at $4,600, which is a massive psychological level for us. On the 4-hour chart, the MACD is showing some negative divergence, so we need to be careful. The RSI is sitting near 44, meaning we aren't quite oversold yet on the daily time frame. Watch for a break below $4,524 to trigger more selling. Resistance is thick at $4,775 an ounce right now. If we reclaim that resistance, we could see a quick run back toward the $5,000 mark. To recap, the March 31st to April 2nd window was an absolute whirlwind of geopolitical drama. Trump's primetime address on April 1st sent oil prices soaring and stocks into a proper tailspin. Copper hit a massive record high of $5.68 as industrial demand remains tight. The Magnificent Seven are having a shocker, with Microsoft and Tesla leading the sharpest declines YTD. Gold is in a corrective phase, but the $4,600 support is holding the line. Volatility in oil, as seen in the OVX, is at extreme levels, keeping the entire market on edge. We are seeing a major rotation out of tech and into hard assets like metals and energy infrastructure. So, what's your play for the next 48 hours? Are you buying the tech dip or stacking more gold? Drop a comment with your price target for gold by the end of April. I want to see your calls. Make sure you hit that like button and subscribe to Goldie Gains so you never miss a golden entry. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!